The United States government has convened an emergency meeting on critical minerals scheduled for Wednesday. This follows a historic 41% crash in silver, the worst in 46 years. Consider this. Why would the world's most powerful government summon international delegations to discuss minerals in the very week those assets collapsed? What crucial information are they acting upon? Meanwhile, as Western markets watched silver plummet from $121 to $72, as headlines declared the end of precious metals, a profound disconnect emerged. On the other side of the world, buyers were acquiring physical silver at a 29% premium over the crashing paper price. They were not selling in panic, they were buying with purpose. By the end of this analysis, a clear timeline will redefine your understanding of this event. You will discover who was buying during the sell-off and see 3 critical facts omitted by mainstream media. These points reveal a narrative starkly different from the dominant headlines. Welcome to an examination of the moves behind the curtain. To understand the crash, we must first see the frenzy that preceded it. Silver skyrocketed from $30 in early 2025 to $121 by late January 2026, a 300% gain in 13 months. The third fact involves a major strategic shift by a financial giant. JP Morgan, a dominant force in precious metals, recently relocated its global gold trading desk from New York or London to Singapore. This is a costly, long-term strategic move, not a tactical adjustment. It positions the bank at the heart of the Asian physical market, where demand is surging and premiums are high. This relocation signals a belief that the center of gravity for precious metals has permanently shifted east. It is a decisive bet on the future of physical asset trading, aligning with regions actively stockpiling resources. These dots connect to the upcoming U.S. government meeting. On Wednesday, February 4th, Secretary of State Marco Rubio hosts the inaugural Critical Minerals Ministerial. The agenda to strengthen and diversify supply chains is diplomatic language for addressing a strategic vulnerability. Silver sits at the heart of this concern. It is not a relic. It is an irreplaceable industrial metal. The world consumed 680 million ounces for industrial purposes in 2025, 60% of total demand, in products like solar panels, EVs, and semiconductors. The market has been in a structural supply deficit for years, drawing down finite stockpiles. New supply is constrained as silver is largely a byproduct of copper and zinc mining, with new mines taking a decade to develop. This meeting could catalyze policies like government stockpiling, export controls, or domestic mining incentives, fundamentally altering the demand landscape. Consider the consolidated timeline. Late January saw euphoric highs. January 30th brought the 37% crash. That weekend, margin hikes forced more selling. By February 3rd, silver hit $72. Simultaneously, Shanghai prices held at a huge premium, and its exchange imposed strict controls. Silver then rebounded to $85. On February 4th, the U.S. holds its emergency minerals meeting. JP Morgan is already in Singapore. This sequence does not appear coincidental. It suggests a seismic event revealing a deeper rift between paper and physical markets. Ray Dalio's recent framework is illuminating. He notes that true bear markets begin with sustained liquidity drainage, not a single crash. The trigger for this silver crash, a slightly less dovish Fed outlook, was disproportionately small compared to the violent 41% reaction. This indicates the collapse was in the speculative leverage and weak hands, not necessarily the fundamental long-term thesis. History offers a parallel. After gold's 50% crash in the mid-1970s, many declared the bull market dead. It then rallied 400% to $800. The crash eliminated the tourists. The structural trend continued for prepared investors. The nature of the recovery is critical. Silver's 18% bounce from $72 to $85 and gold's rebound from $4,400 to $4,800 were swift and held. Assets in a terminal decline do not recover with such conviction. This bounce was likely supported by inelastic industrial demand. For instance, silver paste is a non-optional component in solar panels, representing a small portion of total cost, but 100% essential for production. This physical need-to-buy demand provides a fundamental floor that paper volatility cannot erase. Of course, real risks remain. The correction was severe and needed. Analysts like Marko Kolanovic warn silver could test $50 as speculation unwinds. A stronger dollar or global slowdown could pressure metals. This is not financial advice, and caution is essential. The key this week is to monitor the outcome of the U.S. minerals meeting. Any announcement regarding government stockpiling or strategic reserves for silver would be a game changer, introducing a non-speculative, price-insensitive buyer to the market. Also, watch if the Shanghai premium remains elevated, signaling continued physical tightness. So let's revisit the pivotal questions. If this was merely a popped bubble, why does Shanghai pay a 29% premium? If demand vanished, why did China suspend funds to curb buying, not selling? If silver is irrelevant, why did JP Morgan move its core desk to Asia? And if it's unimportant, why is the U.S. government holding an emergency meeting? The mainstream narrative has no answer. A personal synthesis of this data suggests January 30th, 2026 may be remembered as the day the paper and physical silver markets divorced. The paper market, built on leverage, broke. The physical market, fueled by strategic and industrial necessity, demonstrated shocking resilience. Wealth did not evaporate. It transferred from those who panicked at red screens to those who saw value amid chaos. The right question is not, is silver dead, but which silver? The paper contract may be broken, but the physical metal, essential for technology, energy, and security, has never been more critically alive. The 1,874% explosion in the East-West premium over the past year may be the most important chart pointing to the future. Gold and silver are in free fall as we speak. This is not a slow drift lower, not a minor pullback, not a healthy consolidation. This is a true free fall. While I record, gold just cracked 4,600. Silver is at 72. Every screen refresh shows a lower number, 4,550, then 4,520. It is not stopping. This is no longer a correction. This is a live crash happening in real time as you watch. Friday was supposed to be the worst. Silver down 38%, gold down 16%, the worst single day in 45 years. The consensus was that it was over. Everyone thought the selling was exhausted. Everyone believed the bottom was found. This is pure liquidation, forced selling, cascading margin calls rippling through the system. Traders are being wiped out, position by position, account by account. And it is accelerating, not slowing. Welcome. If you're new, I reveal what is truly happening in markets while others are distracted. Subscribe now for analysis you won't find elsewhere. If this video provides value, smash the like button. It helps the algorithm share this with those who need to see it. In my last video, I showed you the exact level of 117 where silver crashed. Back then people commented it was going to 118 to 120. But let's look at the data. This morning at the open, thousands tried to sell their silver ETFs. Orders were rejected. Circuit breaker breached. Friday's crash was so severe that today's prices remain below the circuit limit. The exchange is not accepting sell orders. Those who held over the weekend hoping to exit Monday morning are now trapped. They cannot sell at any price. The system is blocking them. This is unfolding right now as gold breaks 4,500 and silver crashes through 72. This video explains why and how to protect yourself. The weapon is called a margin hike. When you trade futures, you post a deposit, typically around 10%. Here is why March matters, and it's critical. March futures contracts represent 528 million ounces of promised delivery. That is the amount of silver promised to traders holding March contracts. The vault holds 113 million ounces. Read that again. 528 million promised, 113 million available. They have promised nearly 5 times more silver than physically exists in the entire COMEX system. First notice day is March 27th. That's when every March contract holder must declare cash settlement or physical delivery. If just 22% demand delivery, the vault is completely empty. Not strained, empty. What happens when the 23rd% shows up asking for their metal? This is the nightmare scenario the CME and Shanghai are desperately trying to avoid. This is why we see coordinated margin hikes. They need to shake out the longs before delivery demands expose the entire system. And it's working. Look at your screen. Gold 4,500, silver 72. Longs are being exterminated. But here's the smoking gun, the evidence this crash is manufactured. Pull up 2 prices right now. COMEX silver, the paper price you see on CNBC, is $72 and falling. Now look up Shanghai silver, the physical price where real metal trades. It's at $100. Same metal, same day, same planet. A $28 difference. You need to understand how insane this is. Paper silver New York trades at $72. Physical silver in Shanghai trades at $100. A 39% premium. If silver were truly worth $72, why would sophisticated Chinese manufacturers pay $100? They wouldn't unless they know something. They know the paper price is fake. They know $72 is manipulated. They know real value is closer to $100. And here's what should really unsettle you. The gap is closing. Friday, it was $25. Monday, it was $30. Today, even as COMEX crashes harder, the gap holds at $28. Shanghai is not crashing with New York. Physical is holding while paper collapses. Think about that. If this were a real crash driven by supply and demand, both markets would fall together. They are not. Paper is in free fall. Physical is steady. That tells you everything. The paper price is being pushed down artificially. The physical price reflects reality. One of these prices is a lie, and I think you know which one. So who benefits from that lie? JP Morgan holds the largest short position in silver of any bank in history. Every dollar silver drops, they make hundreds of millions. Bank of America, massive shorts. HSBC, massive shorts. These banks sit on CME committees. They have visibility into positioning. They know the pressure points. On Friday, regular traders lost 38%. These banks made billions. Today, as gold and silver crash further, they make billions more. I'm not alleging crimes. Short selling is legal. Committee seats are legal. I'm pointing out that the entities profiting most from this crash have the most influence over exchange policy. Draw your own conclusions. The timing last week also matters. Thursday evening, Reuters published a story claiming the U.S. government was ending support for strategic metals. Anonymous sources, algorithms triggered selling, and a cascade began. 3 hours later, the Energy Department stated the article is false and relies on sources that are misinformed or deliberately misleading. False, completely made up. But the markets had already crashed. Algorithms don't reverse for corrections. Also on Thursday night, the nomination of a hawkish Fed chair was leaked. The official announcement came Friday morning. Insiders knew Thursday night. Fake news, leaked nominations, 8 margin hikes, all in the same window. Coincidence? And here's something I found this morning that nobody is reporting. The day before the crash, Thursday, there was unusual options activity on silver ETFs, massive put buying. Someone made huge bets that silver would collapse the day before it happened. Either someone got very lucky, or someone knew what was coming. Now, consider the traders who tried to get out. They couldn't. In China, the UBS SDIC silver fund was halted completely. No trades executed. Imagine watching silver crash 30% and being unable to sell, clicking the sell button with nothing happening, refreshing the page, calling customer service, listening to hold music while your net worth evaporates and the exit is locked. That happened to thousands. In the US, the ProShares Ultra Silver Fund dropped 62%. If you had $100,000 Thursday night, you had $38,000 Friday evening, 62% gone in one session. The iShares Silver Trust dropped 31%, its worst day ever. But the price drops weren't the worst part. Traders tried to sell, orders were rejected, platforms showed error messages, systems were overloaded. Customer service wait times exceeded 2 hours. One trader messaged me saying he tried to close his futures position for 18 hours straight. Every order was rejected. He watched his account drain, unable to stop it. As of last night, some traders still reported account access issues. Days later, still locked out. They crashed the price, then blocked the exits, then raised margins again. Think about that sequence. Crash, lock, raise. If you designed a system to destroy long positions and transfer wealth from retail to institutional shorts, this is exactly how you'd build it. Now, here's the fundamental picture that makes this crash insane. It makes no fundamental sense. Silver has been in a supply deficit for 5 consecutive years. Solar needs it. EVs need it. AI chips need it. iPhones need it. Demand is exploding. Mine supply is flat. The cumulative shortfall since 2019 is 1.3 billion ounces, 18 months of global production gone. And then China locked the door. On January 1st, 2026, silver was added to China's strategic materials list, requiring export licenses. Volumes are down 40%. China refines 65% of the world's silver. They just told the West to find another supplier. There is no other supplier. This crash is destroying real businesses. In Rajkot, India's jewelry trading hub, 44 firms declared bankruptcy last week with $425 million in losses. Families in the trade for generations wiped out. In London, 2 hedge funds have suspended redemptions. They can't give investors money back because their silver positions are underwater and they can't sell. In Dubai, physical silver premiums spiked to 15% over spot. Dealers can't get enough metal. This crash is creating wreckage across the global financial system, and we are only a few days in. Now connect the dots. A 5-year supply deficit, exploding demand, China restricting exports, and the price is crashing. This only makes sense if paper is being manipulated down ahead of March delivery. I believe physical wins. It always wins. Paper promises can be printed infinitely. Metal cannot. That truth is held for 5,000 years. But right now, paper is winning. Gold at 4,500, silver at 72, longs being destroyed. So what happens next? Where does this end? No one can tell you the exact bottom. Anyone claiming certainty is lying. I won't give you price targets because in a crash like this, targets are meaningless. Support levels are breaking like glass. Instead, watch for signs. The Shanghai Premium, currently $28. This is the truth teller, the gap between paper and physical value. If it widens to $40, paper loses all credibility. If it narrows because physical starts dropping, the manipulation thesis might be wrong. But if it narrows because paper rises to meet physical, the game is changing. This gap tells you everything. Watch COMEX vault levels. Every Friday they release data. Last week, 33 million ounces left. If another 20-30 million leaves this week, the vault will be nearly empty before March. Who is taking this metal? Where is it going? Why are institutions moving physical silver while the price crashes? They know something. Watch lease rates, currently 8 to 10%. Normal is 0.5%. This spike means physical metal is desperately hard to find. The last times rates hit these levels were 1980 and 2011. Both times, something big followed. Watch March open interest. If traders are capitulating, it drops. If they are holding despite the pain, it stays elevated. High open interest going into first notice day means delivery pressure, exactly what the exchanges fear. Watch for trading halts and platform freezes. If more funds are halted, if more traders are locked out, the system is under severe stress. Functioning markets do not freeze. Stressed markets do. Shanghai premium, vault levels, lease rates, March open interest, system stress. Track these. The data will tell you what's happening before anyone else figures it out. A widening premium means paper is losing credibility. Spiking lease rates mean institutions can't find metal. Platform freezes mean the system is breaking. These are not just numbers, they are warning lights. Understand this, what you're watching is not random. It is not normal market behavior. It is not simple profit taking. It is 8 margin hikes in 8 weeks, unprecedented. It is the CME and Shanghai coordinating on the same day, enemies moving together. It is unusual options activity the day before the crash. It is a $28 gap between paper and physical, a divergence that shouldn't exist. It is vaults draining at 26% per week, smart money running for physical. It is traders locked out of accounts, unable to exit. It is 44 firms bankrupt in India, hedge funds freezing redemptions, physical premiums spiking globally. This is a coordinated attack on long positions, designed to shake them out before March delivery demands, expose the fractional reserve nature of the COMEX. It is working. The attack is working. Longs are being destroyed right now, gold 4,500, silver 72. But the fundamentals have not changed. The shortage is real, the deficit is real. Physical trades at $100 while paper trades at $72. At some point, this ends. Paper reconciles with physical. It always does. The question is whether you survive until that moment, whether you can hold through the pain, whether your stops were hit, whether margin calls forced you out. The trader who messaged me Sunday night did not survive. He was right about everything, and he still got destroyed. Ask yourself tonight, do I understand my exposure? Do I have an exit plan? Is my position sized for survival, or am I one margin call away from losing everything? The winners in markets like this are not those who predict perfectly. They are those who survive, who manage risk, who stay calm while others panic. Survive until clarity, then act. This is not financial advice. Your money, your decisions. But if you're watching gold crash through 4,500 and silver collapse through 72, you need to understand what you're actually looking at. You need the full picture. The margin hikes, the coordination, the physical divergence, the vault drain. That is what this video gave you. The complete picture. Gold at 4,500, silver at 72, Shanghai at 100. The gap is screaming. Paper and physical cannot stay this far apart forever. When it closes, someone will have bought at the bottom. Someone will have held through the pain. Someone will have seen what others missed. That could be you, or you could be the trader who messaged me Sunday night. The difference isn't luck, it's risk management. Share your thoughts on this crash in the comments. Share this with someone who needs it. Subscribe. I'm covering this daily until it breaks. See you tomorrow.